Long put calendar spreads. The trader who uses this strategy, they're looking for a stock price that's going to rise a little bit during the life of the near-term option and then fall when that further out option expires. So on the other side of that coin, they also are hoping for a significant increase in implied volatility levels. So let's look at an example here. This is Southwest Airlines, and when I did this video, it was trading at $39.59. So I want you to pretend that you're just a little bit bullish in the short term. You expect this stock to take a run through that current resistance level, while slightly above this level is just another resistance level. You're expecting the price to be rejected, and for Southwest Airlines, LUV, love, to head to the downside. So for the first put, we're going to go out 21 days for expiration, and we're going to sell a slightly out of the money contract at the strike price of $39. So let's pretend, just for math, we receive the ask price, and we receive 97 cents or $97 in premium. Remember, when you sell the option, you receive premium. But now we need to buy a contract for the other half. And for this, we're going to go out 42 days to the $39 strike price as well. So example here, let's pretend we got filled at the bid price and we pay $1.33 or $133 for the entire contract. Now, due to the lack of open interest here, this is not a contract that we would look at taking at NetPicks. This is for illustrations only. But overall, this trade is going to cost us the $133 that we need to spend to buy, the $97 that we received in premium. The difference, $36. That's what we're going to have to pay. So we want love to be at or very near that strike price of $39 by December expiration. We do not want price to be below it and run the risk of assignment. So what's max risk? The most that you can lose when you implement a long calendar spread with puts is the amount that you spend at the spread, including commissions. So in our example, the most that we're going to lose at this is $36. If the stock price strays too far from the strike price, the puts are going to become worthless and you're going to lose whatever you paid for the spread. That max loss occurs when those two options reach parity, so they're equal. And this happens if the underlying stock goes up enough that both options become worthless, or if the stock declined enough that both options go deep in the money and trade it at their intrinsic value. So in either case, the loss is the premium that you pay to establish the position. So when do we hit break even on these trades? There are two possible points of break even, and these are going to happen if that stock has a sharp move higher or lower before the short-term put expires. But because the value of this trade is heavily influenced by volatility, it's really impossible to calculate exactly where these points are located. So here's a scenario. So the stock's at $39.59 and we sold a December 23rd put for 97 cents, purchased a January 13th put for $1.33. So our cost on the trade is $36 for the contract. So if love trades down to $36 by December expiration, those puts expire worthless. So we're still sitting with the January puts that we bought, and they're now worth $30. That's the decline in stock price, minus the 36 cents that we paid in premium, or $2.64. That's our profit. Now, some traders may hold on to the puts that they bought, a short position, as they expect that stock to continue to drop. But imagine that love traded up to $44 by the early expiration date. December puts are now worthless. Your January puts are far out of the money. You probably want to close your trade. In a perfect world, love does trade lower, but does so after the near month contract expires. So if a trader bought those puts that you sold and they decide to exercise their near-term option, that longer-term put, it's going to remain to provide a hedge against a potentially large transaction. Remember, when you sell a contract, you are obligated to buy or sell the underlying if the buyer of that option exercises their right. However, only about 7% of all option contracts are ever exercised. To wrap this up, long put counter spreads, they offer limited risk with good potential for profits. Not great, but it's good. By understanding the risks and the scenarios that are associated with this trade, you can potentially use it to your advantage when you're trying to capitalize on quick market movements. But it's important to remember that the risk of the option being exercised when you sell, it's always present no matter what strategy you use. So you should always be aware of and prepared for that possibility when you implement these kind of spreads. You can actually learn to trade without using overused technical indicators. Remember, a lot of people just have so many indicators on their charts. So if you're looking for these kind of trades, this is a price action pattern. It's a free PDF guide. No indicators are required. It's absolutely free. You can click the link here or it's below in the description. Thanks for watching.